Hi, this is Alan Gassman, and it's about 5:30 on Thursday, August 25th, and I'm here today with Chuck Wasson to talk about what Mary Poppins didn't know about umbrellas. Ensure that your insurances will insure you. Chuck, welcome.
Thank you, Alan.
For everyone listening, Chuck is the president of Sandy Wasson and Associates Insurance, and he's been with that company since 1992. It was founded by his mother, who was very well respected in the industry. Before that, he was an insurance adjuster. He spent the last 30 days of his adjusting career in Miami following Hurricane Andrew. So Chuck really understands the details of what's covered and what's not covered under an insurance policy. Chuck specializes in providing insurance services for physicians and, of course, other businesses and individuals as well, and has promised to give us a whirlwind tour in what's left of this 15-minute webinar. Chuck, I'm going to go ahead and start on page 1, which actually on page 2. First, a little commercial, anyone who's watching. Our next webinar with Chuck is going to be on September 12 at 5:30. That's Monday, September 12 on 5:30, called Riders on the Storm, How to Make Sure Your Insurances Don't Have Catastrophic Exceptions. That's going to be real important for anyone who is trying to make sure that their insurance packages are sound. Okay, page 3, we're going to charge right into understanding your liability insurance coverage. And I'm going to tell you most of what I know about umbrella liability insurance in about 1 minute, and then we're going to let Chuck fill in a lot of gaps here, figuratively. So what you have here on this chart is your normal policies across the bottom, and the vast majority of people don't realize it, but you have one policy typically for your homeowner's policy for your house, and you may have had to have that, sorry about that, you may have had to have that from Citizens if you weren't able to get a standard carrier. And then you have a second policy on your car. Typically it can be a completely separate carrier. Then you have a third policy on your vacation home, if you have a vacation home. And then if you have a big boat, you may have a fourth policy. So these are all policies that you have to have and maintain, that your agency will have and maintain for you. And then if you want more than $250,000 coverage, typically, you have to buy a completely separate policy. And that's called the umbrella policy. So if I get sued for more than $250,000 while I've been driving, then I typically will have my car policy answer for the first $250,000, and then my umbrella policy cover whatever is above the $250,000. So I need to make sure that my umbrella policy and my other policies are put together properly. And I also may have to have a separate umbrella. If my vacation home is outside of Florida and I have a big boat at my vacation home, I may need a Michigan umbrella policy. And all of that needs to be coordinated. And I know from my experience as an estate planning lawyer that quite often I will call the insurance agencies. I'll get them all on the phone on one phone call, or I'll send them emails or letters, and we'll find some pretty big gaps in the coverage. So Chuck, I'm going to pretty much let you take it from here.
Sure. The underlying policies, the big important thing is having the adequate underlying limits. And like Alan said, most do it for automobiles is a minimum of $250,000, and for most homeowners policies it's $300,000. I have seen many of my clients that still opt to have $100,000 on their homeowners policy regardless of the carrier, which in essence can leave almost a $200,000 gap. When you look at the underlying policies before the umbrella policy is triggered, think of the underlying policy as like a big deductible. Once that underlying policy limit is exhausted is when the umbrella policy will kick in. For those people that are the high net worth people, I do have clients that have excess of $10 and $15 million umbrellas. What happens with that is you're generally not going to find one carrier that's going to write that limit. So oftentimes, on top of the $5 million umbrella, we may have to stack another $10 million or $5 million umbrella. And that's when it starts getting a little dicey when you start looking at the underlying limits, because you want to make sure that the base policy, the basic homeowners and auto policy has adequate limits. Then the next umbrella has the adequate limit, and that's because it's almost like another deductible, and you keep stacking those policies up until the desired limit.
Now, and Chuck, yesterday I had a conversation for a client who has $10 million of coverage, but he has a regular policy, then he has a $5 million umbrella, then he's got a separate umbrella to go from 5 to 10.
That's correct.
Is that common?
That's correct, because most of the carriers don't want to be on the risk for more than $5 million at a time. There are instances where we have to put maybe a $10 million umbrella because of the market, the general market, we can't find it. In those kind of situations, we're often going to the London market, Lloyd's of London, like everyone's heard of, which writes some obscure type policies. We may have to go overseas to find those type policies.
Okay, and before we leave this page, I just want to make sure we talk about what a drop-down umbrella is. Now, the way I understand it, Chuck, that Citizens and some other carriers don't handle certain risks like accidents from pools and pets. And then if they don't handle it, a lot of umbrellas only will answer claims that are covered under the underlying policy.
That's correct. That's called what they call a following form umbrella, which means that the umbrella is only going to, if it's not a drop-down umbrella and it's a following form, it means that the umbrella is only going to cover those liability exposures that are covered under the underlying policy. There are policies out there that do drop down and cover, and with an umbrella market, it's vastly different. Each company has different guidelines, different underwriting requirements. So there's no one set umbrella company that's alike. They're all different. So what we need to do generally is shop the market with the various umbrella companies to try to find if an underlying exposure is not covered, to go out and search to see if it's available, to find through an umbrella that will provide drop down, that will come drop down to the underlying policy and fill that gap.
Okay, I want to make just a couple more points before we go to the next slide. The first point being that a lot of clients think that going from $1 million of umbrella coverage to 3 or 4 or 5 is very, very expensive. And it's certainly not 5 times as expensive to go from $1 million to $5 million. The rates really are not that much. Secondly, I wanted to point out that when you increase your umbrella coverage, you are often increasing your uninsured motorist coverage. And that can be a very good investment because with uninsured motorist coverage, if the person who hits you doesn't have enough coverage and you would be able to sue them, then your own insurance company gives you the money that you would have been able to sue them for. So when you're upping your umbrella coverage and it's giving you more uninsured motorist coverage, it's a nice benefit. Does that sound right?
That's absolutely correct. And I was at a meeting last week, a statewide association meeting, and the uninsured motorist issue came up, and what the state believes, it's hard to quantify, but they expect that there are probably 40 to 45% of the people in the state of Florida that do not have insurance. Bodily injury is not required. Personal injury protection and property damage are only required. Forms of auto insurance that are required. Bodily injury is not required at all.
Okay. So I'm going to go, just for the reference of everyone watching, I'm going to go to page 4 and tell you that this is a cover letter that we typically provide for clients who may want to ask their insurance agents if they have enough coverage. And if anyone would like for me to send you a Word version or a WordPerfect version of this letter that you could use, you are more than welcome to. But this is the letter that we send. This is the letter where I explain it to the client. Now, pages 5 and 6. Page 5, I have a letter that the client can fill out to send to the insurance agent. And this helps remind the client, well, yeah, do you know about our boat? Do you know about our all-terrain vehicles? Do you know about our wave runners? Do you know about our vacation home? Oops, forgot to tell you that we're at the timeshare 2 weeks a year. So this is something that the advisors watching and the clients watching might have some use for. Now, Chuck, I'm going to go to page 6, and then page 6 and the subsequent pages are some samples that you've provided us with that you can help describe now for educational purposes. What we have in black is the actual sample document you gave us. What we have in red is what we circled, which is what we think you're calling most important, and in blue we have notes that help explain each slide. So go ahead.
The next couple of pages are what's called the declaration page, and this is usually probably the first 2 to 3 pages of an insurance policy, and it lists all the specifics about the policy. You can see the first circle we've got, it lists the drivers in the household. An umbrella carrier is going to want to see that because they're going to make sure that they underwrite all the drivers in the household. Actually, right above that, what's not circled, is also going to list all the vehicles that are going to be covered by the auto policy, which in turn are going to be covered by the umbrella policy. The circle at the bottom is the liability limits, all the way from personal injury protection, bodily injury, property damage, all the way down the line. And as you can see, this person pretty much, it's got a little bit better than the basic coverage because it does have a little bit of bodily injury coverage, but it only has a limit of what they call 1020 or 10,000 per person, 20,000 per accident. And this is woefully under what a liability carrier would require to write an umbrella.
Okay.
And then right next to that, there's just the premium breakdown per vehicle, so you can see where the premium is being charged for that vehicle.
Excellent. Okay, then I'll go to the Progressive policy here on page 7.
And this is another one. All the declarations pages on the various insurance companies, they're a little bit different, but they all show the exact same information. On this one, when you look at the circle, you look at this person has a combined single limit, where the previous one had a split limit of 1020. This one has a combined limit of 300,000, which would cover the bodily injury and property damage of any one accident. And then it's got the 10,000, which is the statutory required personal injury protection. And then this one has the uninsured motorist, and then a list of deductibles for the comprehensive and collision.
Okay. So should we go to the slide 8?
Sure.
Which is the boat. Now, what
boat
size boat is normally included with an umbrella? What size boat do you need normally?
Well, there's no, generally for the standard umbrella, we're going to show a slide later, which is RLI, which is a very, very economical umbrella. They're looking at, boats that are probably in the 45 to 55 horsepower. They're not looking for the high-speed boats. They're not looking for the cigarette boats, the big cabin cruisers. That's specifically going to be excluded. For the clients that have those bigger boats, we have to go other markets that are pretty much geared towards more of the high net value, net worth client that's going to have kind of the bigger toys. Most of the umbrellas that we deal with, that we see a lot of, are just regular people that don't have umbrellas. And the other issue that we have with some carriers is youthful operators. A lot of carriers who write umbrella don't want to see anyone with a youthful operator in a household, which means we have to go to an alternative market for those risks as well. And then on the boat here, it shows this individual person, just like the auto. This one's got 100, 300. So in a boat declarations page, it's going to look very much like a auto declarations page.
I see. Okay. Then capital flood insurance on page 9.
And we went ahead and threw, since we're looking at declarations pages, we went ahead and threw a flood policy in here. A lot of people don't understand how their flood policies work. Flood is written by FEMA, which means that no matter which carrier you go to, it's the same price. And the maximum for a house is $250,000. The maximum of the contents is $100,000. Even though clients may have values much higher than that, this is the basic policy, and anyone who wants something above this is going to go to an excess flood carrier. Really doesn't go underneath an umbrella, but we wanted to show what a flood policy declaration page would look like.
I didn't realize. So everybody needs to make sure they have excess flood insurance if they have a lot of risk.
The mortgage holders don't require. Even if you're in a flood zone, they only require the basic policy. But I encourage most of my clients to get at least some of the excess flood for anything above $250,000.
Okay, thanks. And by the way, of course, anyone watching this, if you want to see this again, we're going to replay it on our website. If you want to forward it to somebody, we'll be able to link it for you. Or if you want copies of these handouts, we'll be glad to email them to you. Okay. Then on page 10, your metropolitan homeowners deck.
This is your homeowner's policy, very similar to the auto, where you're going to see the value of the home, and then what's circled is the $300,000, which generally is the most an insurance company will write a liability policy for, and then we would layer the umbrella on top of this. And if there was an incident at the home where someone slipped and fell or injured themselves, and your homeowner's policy will cover up to $300,000, and then the umbrella coverage would be triggered after that's exhausted.
Yeah, I'm just going to mention here, I do have one client in litigation with an insurance agency because he bought an RV umbrella that required underlying coverage of $500,000, but his underlying coverage was only $250,000.
Yeah, so you got basically a $250,000 gap in coverage right there.
So he had to write a $250,000 check to settle the case. So it's real important to be careful with these things. Okay, page 11.
This is similar. This is a citizens declarations page. See, it's very similar to what the other ones were. Once again, it shows the value of the home, and once again, $300,000 in liability.
Okay.
Not much different than the other ones, but just the format's just a little bit different.
Right. Okay, and then page 12.
These are just, when you start looking, people often don't look at the various other pages other than maybe the first, second, third page of their homeowner's policy. And this just shows that some of the credits that people can get. If they happen to have sprinklers, a fire alarm, burglar alarm, there are credits that an individual can get. It's not going to cover the cost of your monthly monitoring or the cost of installation, but it does give you some credit on your homeowner's policy.
I can't imagine not having a burglar alarm in your home in this day and age.
Absolutely.
Or a fire alarm.
Exactly.
Wow.
Exactly.
Okay. All right, then page 13.
This is just the disclaimer that you're going to see where it talks about you've got a separate deductible for windstorm losses, and that's going to be reflected as a percentage of the value, not percentage of the loss, a percentage of the value. So if you've got a $100,000 house, it's going to be 2% or 5%, whatever the percentage is of that $100,000. Right below that, we see law or ordinance coverage. You automatically have this, a portion of this on your policy, and what this covers is what the insurance company is going to do if there's a catastrophe to your house. They're going to put you in the same position you were prior to the loss. But what happens with older homes is building codes may have changed, which means that you have to pay an additional amount to bring it up to the current code. Well, ordinance of law helps pay for that. Generally, the policies have about 25% of the value of the home built in to pay that extra cost, but you can increase it to usually up to 50% of the value. So if you've got, just round numbers, you've got a $100,000 house, you have a catastrophe, you've got $25,000, but you can buy up to $50,000 to bring it up to today's codes.
Okay. Now Chuck, we had advertised this as a 15-minute webinar, and I've spoken too long, so we've got about 3 minutes left, and we've got a bunch of slides. Should I just stay in the same order here?
Yeah, just
Is
flip
there
through all
anything in particular you want to make sure just that we cover?
Yeah, this is a checklist that you're going to see on your policy that is going to do, a little bit of a quick recap of what your policy covers. Most policies have this in some form. So make sure, the reason all this is make sure you really look at your policy. Just don't look at the first couple of pages, or sit down with your agent and have them explain each of the coverages.
So if you can, you try to sit down with clients every 3 years, or how often would you
lately
try to
it's
sit
been
down
almost
with
every
people?
year.
Wow.
Every year we're talking to them to make sure, because a lot of people change, and unfortunately insurance is one of the last things they think about letting us know when they've made a big purchase.
I mean, you guys get paid a commission to write the insurance, and you'll probably make a lot more money if you just write it and don't check all the details and sit down with the client, but you'll really earn your fee, and everybody will be safer if you sit down with the client and go through all of this,
Exactly.
right?
Exactly.
Okay. All right.
Just this is more the checklists that are part of the policy.
Okay, so each policy has a checklist that the person.
Yeah, they usually have a little brief recap on towards that kind of summarizes all the coverages within the policy.
Amazing.
If not, the agent can put one together for you.
Okay, and then the choice insurance declaration page.
Yeah, this is a different company with a different declarations page.
Okay. All right, and then the United Animal Liability coverage.
Yeah,
that's going to be important.
Big problem we're seeing now is almost all the policies now are excluding animal liability. It used to be just limited to certain breeds of dogs. Now they've gone straight to blanket animal liability. They've had issues with birds, snakes. They've had a lot of problems, other than, bad dogs. So they've just gone to a straight animal liability coverage.
Yeah, I was recently reading a case where a dog ran into a motorcycle, and the motorcycle driver died and sued the owners for letting the dog out.
Exactly.
And I don't think they had the coverage for it.
Most of the carriers, I think the next couple of slides are going to show this. You can buy back some of it, and it depends on what the limit of the insurance company, what they will sell. Citizens, you can't buy back any animal liability coverage. But some of the other carriers, like we're showing United here, you can get up to $100,000.
Oh, you just pay extra to cover your dog and your. I see.
Exactly. But also you got to look at any endorsement that may take coverage back away, such as this one right here. It talks about, if you've got a dog that's got a propensity to bite or has a bite history, there's going to be no coverage even if you bought the liability coverage. And anything that is what they consider dangerous or exotic, they're not going to cover that even if you bought the liability coverage. Best thing is to do is when we always ask what type of animals are in the household. We want to know everything that's in the household to let them know if they do decide to buy back a little bit of the coverage. If it's an exotic pet, we let them know that even though they buy it, it's still not going to be covered.
Wow, no lions or tigers I see
no lions
either.
Or tigers.
And no trampolines.
No trampolines, and they are doing inspections, so they're going to look at that. So if you say you don't have a trampoline, if you don't have a diving board or slide, they're going to at some point they're going to inspect the property, and they're either going to cancel you. Technically they can cancel you in the spot for material misrepresentation. basically
Wow.
the policy.
Now I'm going to skip to number 25. I see you've got pool requirements. You can't just have pool coverage. You got to make sure you meet the requirements.
Exactly. They're all going to want to be at least enclosed and fenced. And like I said, they're going to inspect it to make sure that what you put on the application, even what the agents put on the application, is correct. And if they find out that it's not correct, then they're either going to surcharge the policy or they're going to most likely they're going to cancel the policy.
Okay, and then this RLI.
RLI is a great umbrella carrier. I run a lot of business with them, and this is what their declaration page looks at. Looks like the first thing I'll look at the limit of coverage. RLI they write a $1, $2, and $5 million umbrella. And so at the top, underneath the effective dates, they're going to show you how much you've got. And then when you look down at the bottom, they're going to start telling you what the underlying coverage requirements are. And the bottom of this page is the automobile liability. And with this carrier, they're looking either at $250,500 or a combined limit of $300,000.
So all this information is in these policies. You just need to get an idea of where to look
at. Correct.
And to go over it with your agent.
That's correct. And then here's some of the other ones where they talk about on your primary residence what they're looking for as far as underlying coverage.
Okay, and I can just tell you again, you lawyers and accountants who are with us today, and there's several of you, you can do your clients a lot of good just getting on the phone with the agents and saying, is everything covered? Did you know about the SUV? Are you aware of the house in Michigan? Are there any gaps? And that agent will pull the file out, and almost every conversation, something will come up. Chuck, I can't thank you enough, not only for what you've done for our clients over the years and for our firm in backing us up with issues, but also for being here today. It was an excellent presentation, and we're looking forward to being with you again on September 12th for the Riders on the Storm presentation. All right, all of you who stuck with us, and actually everyone who started with us, finished with us, we appreciate any questions or comments or suggestions you might have on this presentation or any future presentations. I'm sorry we ran over, but I hope it was worthwhile.
Good morning, Mr. Gassman. This is your 9 a.m. wake-up call. You have a webinar to do.
Holy smokes! Is it this morning we're doing the webinar? Wow! Look at all these people here. All right. Well, let's do it. Good morning. It is Saturday, August 6th. It's a beautiful morning, and I'm very honored to have so many physicians, clients, and CPAs on the line today listening to this. Now, going to page 2 of our, trying to go to page 2 here. Hold on, we're just, there you go. Go into page 2 if you want to get fancy. This is the instructions on what you hit if you want to speak and ask a question, or if you'd like to raise your hand and send us a question. So Janine is here. She's going to help me manage that, but we'll try to take questions at the end. And our presentation today is on cornflakes and estate planning mistakes, but I wanted to point out for you some other ones that we're doing here. And by the way, all of these get downloaded to our website, so you can watch them at your convenience, and feel free to forward them to other people. We're going to talk about the new Florida Power of Attorney Act on Thursday, August 18 at 5 p.m. That's going to impact a lot of powers of attorney that are done in the future. On August 25th, with Chuck Wasson of Wasson Insurance, we're going to present what Mary Poppins didn't know about umbrellas. Ensure that your insurances will insure you. And that's going to be a 15-minute presentation. Then on Thursday, August 25th at 5:30 p.m., what to do if both spouses are doctors. There's some super challenges and some good opportunities where you have clients where both spouses are doctors. Monday, August 29th, we're giving a B&A national webinar. That one you would have to pay to attend, and that is that dentists are different. It's tax planning for dentists and how the rules uniquely apply to them. Tuesday, August 23rd, we're giving a presentation called Riders on the Storm, how to make sure your insurances don't have catastrophic gaps. So if there's anything else you'd like to see us present, please let me know. And I'm going to go into our presentation now. I have a checklist on page 4 which talks about the most common errors that we see in the estate planning area. And I'm just going to go over these with you now. You can see the cursor here. Number 1, failure to have a proper planning structure. A lot of people have the wrong structure. We'll talk about reasons that they may be wrong. but you want to have a competent planner make sure you have a good structure. Secondly, once you've got a good structure, it's still vitally important to review it periodically and adjust ownership and titling. Any client that comes to me after 2 or 3 years is going to have something that needs to change. It can be a very small adjustment, but sometimes it's very important to have this change. The next item is the failure to have appropriate beneficiary designations for life insurance, retirement accounts, IRAs, and annuities. It's a lot of darn paperwork, but if you make mistakes, then monies go to the wrong places, and you don't want that to happen. Number 4, failure to have enough life insurance. We're going to talk about that. You may need more life insurance now than you did in 2008. In 2008, we had more confidence on what an investment portfolio would earn, and you may have had a greater net worth. Is your family now protected with your life insurance? We're going to talk about that. Number 5, failure to focus on asset protection planning. You know, anytime you do something, you've got to look at it from 2 or 3 angles. And one angle is, how are the creditors' situations going to apply to my estate plan? Number 6, we're going to talk about joint assets between spouses that should be protected if you do it right and aren't protected if you do it wrong. Number 7, we're going to talk about wage accounts, which have the same connotation. Number 8, we're going to talk about making sure you revisit the plan every 2 to 4 years. Number 9, we're going to concentrate on protecting spouses and the next generation. And number 10 is failure to do the estate tax planning. Now, on page 5, my slide says, make sure you have a proper system, a structure. And most clients that we have a structure like this: a revocable trust for each spouse, and on the first death, the amount that can pass estate tax-free goes into a trust that can benefit the spouse without being subject to estate tax at the spouse's level. Now, I really like this. We had a meeting Thursday with a physician client who really didn't see any insurance needs, but we talked about his wife, and she is not a physician. They own their assets jointly for the most part. If she dies, his creditor protection is not good anymore because he owns a lot of assets individually if she dies. So, and she's concerned that he might remarry and then have a new family and that her children would be out in the cold or the warm, depending on the month of the year. So we're putting a $3 million life insurance policy on her. It's going to be payable to her revocable trust, and on her death, he can be a co-trustee. He can get what he needs for health, education, and maintenance, but it's not going to be available to his next wife. So during the meeting, the financial planner said, we're going to get new wife insurance. We need new life insurance on the wife. And it was funny because she took that to mean that we were buying life insurance that was going to cover the next wife. And they don't have that anymore. I mean, they don't have that type of insurance yet, but give them time. All right, page 7, just more on the logistics. You know, you've got to just lay this out for the client. They usually don't understand it, but we do lay out charts, as most of you know, where the husband may have a revocable trust. That revocable trust doesn't provide any creditor protection whatsoever. It just is going to avoid probate, and it might have gotten him a free lunch if he went to one of those free lunch seminars. Other than that, the revocable trust simply turns into the other type of trust from page 6 on death. And then there's tenancy by the entirety's assets, where creditors can't reach these. If you follow all the rules I'm going to talk about, then the wife may have a revocable trust. Then irrevocable trusts for the children have a lot of uses. And when I go to page 8, I show you that depending upon the value of assets, they may want to have subsidiary limited partnerships and LLCs in order to give them a better degree of creditor protection and the ability to do discount gifting. So that's all there on the table. Most of the people attending have already gone through this and understand it very well. So I'm going to go to page 9 now. Now, if you're interested in the estate tax law, let us know and we'll send you excerpts from our V&A book, Estate Tax Planning in 2011 and 2012. And we're looking at making this into an electronic book because I have a strong feeling that these laws are going to change in the next 3 to 5 months as they grapple with the budget situation to get our S&P rating back up. But if you're interested in the book, just give us a call. We'll be glad to at least loan you a copy or send you some excerpts. We've had a really good time writing it, and I don't think I'll ever write a book again. Okay, page 10, ideas for planners with respect to the new estate tax law. go through this chart with your client, or go through this chart on your own to the extent you can understand it, and decide what you're going to do to take into account the new estate tax law. For a lot of clients, they don't want $5 million automatically going into a trust to benefit the spouse or to benefit the children. It used to be $1 million, then it went to $3.5 million, now it's up to $5 million. This may distort what the plan is, so the plan needs to be reviewed. And then there's other things you can do, like number 5, you can clean things up and simplify them. If you're pretty sure the client is never going to have an estate tax issue, it's time to really simplify things. They may not need these trusts and all these entities. We're doing a lot of trust mergers where you had 3 trusts and you merge them into one. And then there may be life insurance policies that people took out to pay the estate tax. And maybe it's time to look at those policies and cash them in or reduce the death benefits. So, and of course, making use of this new allowance for the wealthy clients to set aside $4 or $5 million into a trust that's never going to be subject to estate tax and could benefit the spouse. And if it's put in an asset protection trust jurisdiction, it can even benefit the client who sets it up. And we've been working on these, and they're, very nice. Now, it used to be a client would put $1 million, $2 million into this type of trust. Now it's $4 to $8 million for most clients in 2011 and 2012. So it's really time to spruce up the irrevocable trust forms, which we've been doing, and make sure everything's done properly. It's also a good time with this large allowance to go ahead and forgive notes to children, give them the house that they live in, but maybe ask them to get marital agreements for their children and test those relationships. Okay, number 2, failure to periodically review and adjust ownership. A big question is these joint accounts, are they tenancy by the entireties account? If Marcia and I go in to open a joint account and the account agreement says that we can check a box for tenancy by the entireties or we can check a box for right of survivorship, if we check that box for right of survivorship, then that account is exposed 1/2 to my creditors, 1/2 to Marcia's creditors. So we really have to, even if the account says it's a TBE account on the title, you really have to look at the account agreement to make sure it's TBE. And if it turns out it's not TBE, you can't fix it retroactively. You just have to terminate that account and start a proper TBE account. And then, as I said before, living trusts don't provide asset protection. Sometimes they only get funded on death, and so clients get misled about that. Joint revocable trusts usually will not qualify as tenancy by the entireties. So those are big mistakes that get made. Now, as I said, beneficiary designations, those are a huge, huge issue for many families. For example, if I want to have my pension go to a protective trust for Marcia, if I die, and I have put Marcia on the beneficiary designation and the trust is the alternate beneficiary, that works great. Then I die, Marcia has 9 months to decide whether to roll it into her own IRA or to let it go into the living trust. That's the way to do it. Well, a lot of clients just name the spouse. We advise them to name the trust, but they forget to. Or they did name the trust as alternate, but then they switched brokerage firms, and for some reason the new brokerage firm almost always gets it wrong, and they don't ask the old brokerage firm what it was. So you really have to be careful. I mean, we do have clients who die, and the life insurance just goes to the wrong place. It goes to the wrong person. It's not available to pay bills. So this is drastically important. And I think if you work with us, you know we do all we can to try to make this right. But when clients do it on their own, or the salesperson promises to do it and doesn't do it, it can be a big problem. Page 17. If you're going to buy life insurance, get all you need. It's more important to get the right amount of life insurance, the payment on death, than it is to get a cash value developed under the policy. That's my opinion. When you go and get a life insurance quote, they can either turn it in as a formal application, and then if you get a health issue during the exam, it goes on the bureau, and every insurance company for the rest of time is going to know about it. Alternatively, you can do an informal application where it only goes to 1 or 2 life insurance companies, and they informally let you know whether they would entertain a formal application. And I think that can be very important. All right, then the next page, so that's page 18, I've got representative term life insurance rates. So if you're watching this right now and you're 45 years old, or your wife is 45 years old, and you would like to see what it costs per million to get her insured, if she's a standard risk, then it would only cost $1,100 a year for you to get $1 million if she dies in the first 10 years. So that might be a good thing. If you have children who haven't finished college and or a child that you think will be done with graduate school in 15 years, then maybe look at adding another 15-year policy so that your spouse doesn't have to go through unreasonable hardship. You know, you used to have a lot of equity in your home. Now your home may be upside down. So think about this term life insurance. They want to sell you the permanent life insurance, but you can buy term life insurance, get it in place, and if you want to convert it to permanent life insurance, you can do that later after you take a closer look. Now, number 5, failure to focus on asset protection planning. That's very important. We just have a lot of clients who have done good estate planning, but they just haven't thought through the asset protection planning. For example, I've had a client come in on Tuesday where the husband owns the car that the child is driving, and the wife is the one who signed the form with the Department of Motor Vehicles to be responsible for the child's negligence. So if that child gets in an accident, they're going to say that the husband negligently entrusted the child with the car, that he wasn't trustworthy to drive the car in the rain or something like that. Then they're going to nail the mother. They're going to get a judgment against both spouses, and then they're going to lose all their joint assets except for the homestead. So it's really important to think through the creditor protection planning. Like using an LLC. If Marcia and I have a piece of property on the Swanee River, if it's under an LLC, then if somebody breaks their neck, I may lose the property and the LLC, but I'm not going to lose the rest of my joint assets. And if that LLC is owned 5% by a trust for our children, and somebody does find a way to sue Marcia and I, they're not going to be able to break into that LLC. Or if I pass away and Marcia owns 95% of that LLC and somebody finds a way to sue her, then they're not going to be able to break into that LLC. So just working on the creditor protection planning can be vitally important. It just has to be reviewed. And we find that there are many, many mistakes made by other advisors who mean well. Now, of course, we mean well as also, by the way. All right, page 21. This is just, you can print this out and carry it in your wallet. These are the creditor-exempt assets on the top left-hand side. Your homestead, only up to half an acre within the city limits. Some clients are buying the homestead next door and making one large complex because this is your safest asset from a creditor protection standpoint, assuming you're not going to go into bankruptcy anytime soon. Your IRA, Roth IRA, absolutely protected. Your pension plan, protected if the plan is handled correctly. Permanent life insurance owned by the person insured is going to be protected. Annuity contracts are protected if they're purchased properly, but there are sales charges involved with these, so you should look carefully or maybe consider a non-loaded or low-cost annuity. Wages of the head of household we're going to talk about because there's a lot of mistakes made there. Wage accounts, which we'll talk about in a little while. Tenancy by the entireties as long as no one's suing both spouses. And then I really like these 529 college savings plans. You can do the prepaid tuition, pay about $44,000 a year now for a 10-year-old to have room and board at a Florida college. But you can also open what's pretty much like a mutual fund. It's sponsored by a state, and it's creditor-proof even though it's in your name and you can use it for yourself. If you pull it out for yourself, then you're going to have to pay income tax on the inside earnings, plus an extra 10% tax. But as long as you spend it on anyone's college, it could be your nephew's college, your future girlfriend's college, anyone's college, you never pay taxes on it. So if you don't have a 529 plan and you have children who are going to go through college, you really need to give that some thought. All right, then assets that are difficult for a creditor to obtain. They're not totally exempt, but they're hard to get into. That's these limited partnerships and limited liability companies, offshore trusts, Nevada asset protection trusts, things that we prefer not to use if we can properly use the other things. we try to keep it as simple as possible, but we also try to keep it logical. Assets exposed to creditors, your brokerage account, your individual assets, your joint assets where you both own money, half of your joint assets in a non-TBE account. You're only allowed to keep physical items worth $4,000. So in some families that would just be half of the shoes and everything else would have to go to the creditors. And then vocabulary, an exempt asset is an asset that a creditor can't touch. Charging order is when you own a part ownership in a company or an LLC or a partnership, and the creditor can't reach into it. I'll talk about that in a little while. And then a fraudulent transfer. Under our fraudulent transfer law, which goes back to the 1500s and the rule of Elizabeth in Old England, if a creditor is imminent and you are insolvent and you transfer assets into an exempt category, for example, let's say I have a bank account and I get in a bad car accident, I'm at fault, so I go and I take that bank account and I put it into an annuity contract. Well, if within 4 years the creditor gets a judgment against me and can prove that the transfer caused me to be insolvent or that I mentally intended to avoid the creditor, then this can be set aside. So, the first lesson from that is it was not raining when Noah built the ark. So you want to get this done sooner rather than later. But the second lesson is, let's say I did this fraudulent transfer. Now understand, that's not fraud. Fraud is illegal and you're not supposed to do it. You're not supposed to mislead somebody. You're not supposed to lie to somebody for financial gain. But I haven't lied to anyone in my example. I just moved my bank account into an annuity contract. So the remedy here for the creditor is to set it aside. And maybe they could get attorney's fees. So many times in my career, clients have come to me and said, I've been referred by somebody. I heard, they saw your seminar in Miami for the Florida bar. I've got a problem. I've got a jury trial in 3 weeks, and I've got a CD in my name, and my brother-in-law's a lawyer, and he told me not to move it back 3 years ago when I got sued. So what do I do now? And sometimes the answer is go ahead and move it, because all they can do is take it back. But you really have to think through these things. Number one, get it done in advance. Big mistake not to. Number two, if you didn't get it done in advance, let's take a look at the situation and do the best thing we can. Okay, tenancy by the entireties on page 22. Rodney Dangerfield, my wife and I were happy for 20 years, and then we met. Well, you've got 6 unities you must satisfy in order to qualify property as tenants by the entireties. And fortunately, one of those unities is not getting along with your spouse. You just have to stay married with your spouse. But you have to have all these unities achieved. For example, you have to take title to the asset at the same time. I couldn't take a stock certificate in my name and then just write my wife's name on it later, or take an individual bank account and add her to the account. It has to be a simultaneous ownership. And it has to be only between spouses. I can't add my mother-in-law to the joint account, even though I would really like to. Okay. So that's one reason that we will often have the clients own a tenancy by the entireties LLC or family partnership and have the investments placed in the LLC or the family partnership, so I don't have to worry that they title everything under that entity properly. Now, I have 8 common LLC planning errors from a May 16, 2006 publication we did. The first one being these tenancy by the entireties issues, pointing out that if you have a shareholder agreement and you've gone for a tenancy by the entirety situation, the shareholder agreement or the operating agreement of the entity may be contrary to tenancy by the entireties. For example, if Marcia and I and Frank and Kathy set up a company, and Marcia and I have 50% as tenants by the entireties, and Frank and Kathy have 50% as tenants by the entireties, but the boilerplate language in the operating agreement says that if any one member dies, then XYZ happens. well, then it's not tenancy by the entireties anymore, because Marcia and I don't have an exact unity of interest, because if one of us dies, it's different. So you have to be very careful in your drafting. Most operating agreements that we review that have been done by non-lawyers don't have proper language to allow tenancy by the entireties. And probably 40% of the ones we review by lawyers don't have the right language. So you have to be careful on that. And also, I'm just pointing out, your entity documents could also disqualify your S election, and they could cause you not to have charging order protection. So it's really important. I know there's a lot of CPAs on the call today. It's real important to make sure that your clients not only have operating agreements, bylaws, shareholder agreements, but that you have encouraged them to have them reviewed by a qualified lawyer. It doesn't take long to review them to make sure you don't have these problems. Okay, I'm attempting to scroll now to page 25. I may have to have Janine come over here and help me out. There I am. Okay, I just had my cursor on the wrong page. With 4.5 minutes to go, page 25, another big mistake. If you own real estate outside of Florida, well, first of all, that may be the mistake in itself. Why the heck did you buy real estate outside of Florida? But keep in mind that most states don't have tenancy by entireties. So if you bought a vacation home in Georgia and you put it in joint names with your spouse thinking it was going to be a tenancy by the entireties protected asset, guess what? It's not protected. In fact, if you bought that house in California, it may be exposed 100% to the debts of either spouse, because that's the way California rules work. So you want to think about putting your out-of-state real estate into an LLC and have that LLC owned as tenants by the entireties. That's going to be much safer for you. And then if somebody files a lawsuit because they break their neck on the property, that you've got a firewall protection there. Now, the IRS can invade tenancy by the entireties assets and just about anything else we do. And student loans are not easy to protect either. So we like to do a lot of different things for clients. We like to not put all of their assets under one particular method of creditor protection in case that method gets legislated out of existence. Page 27, wage accounts. If you are the head of your household, which means that you provide more than half of the support of any one person besides yourself, then your wage check should be immune from creditors, assuming that it's earned in Florida. And then if you put that wage check into another creditor-exempt asset, it's not considered a fraudulent transfer. So a lot of clients come to us with a situation where maybe the client has $300,000 cash that's exposed to a creditor, and a jury trial coming up in a year and a half. Well, we'll say, spend down that cash, live on that cash, and we'll bank your wage check directly into a variable annuity or directly into a tenancy by the entireties account. Now, there's also something called a wage account, where the law says if you take your wage check and you put it in a wage account, it's going to be protected there for 6 months. Well, I never like clients having a separate wage account. Here's the reason. If the client's married, then they can just do a tenancy by the entireties account, and they don't need to worry about the 6-month rule. Secondly, the law on the wage account is not yet 100% clear. If the wage account is only safe for 6 months, then is anything you buy from the wage account only safe for 6 months? So if the client wants to put that money directly into a variable annuity, or directly into a tenancy by the entireties account, or directly into a limited partnership, that's going to be safe, and you can eliminate that darn wage account. So we've got the information there. Page 30, what does a doctor do with their money? Well, there are a lot of choices, and I would just encourage everybody to go through the choices. Pension planning, has there been a really good actuary that's looked at a census? I don't mean your local stockbroker who may not know much about this. I mean, has a good, reputable actuary looked at the situation to see what you can put in? Secondly, are you making your children work? The best thing you can do is make your children work, and then you can put them on the payroll, and they have a very low tax rate, and they can open a Roth IRA. Your wages, are you using a wage account? Are you paying fixed monthly periodic wages under an employment agreement? If you don't, then the wages are probably not protected. And are you paying too much in the wages or too little? Then there's dividends, which are not subject to employment taxes. Are you living off of your dividends and banking your wages for creditor protection purposes? Do you have the spouse on the payroll? The spouse's assets are going to be protected. Are you paying rent to a related entity? Are you paying interest to related parties? People, I think, do very well going through this chart and thinking through how their money should flow from their practice. Now, page 31, just an example of why we try to use belts and suspenders and not rely on any one thing. We had a nice charging order law in the state of Florida which always said under the cases that came out that if you got a judgment against somebody, you couldn't reach into the entity if there were multiple members. Well, the Florida Supreme Court got all confused and made a mistaken but binding decision that LLCs would not have charging order protection in Florida. Fortunately, our legislature cleaned that up in June. So we now have charging order protection if you have a multiple member LLC and if it has a proper operating agreement. That's just an example of we don't want to rely on everything. Now, here's a new chart. We're going to go over this in more depth on the Mary Poppins program. But you can use this to show clients that they need several insurance policies. There's your homeowner's policy. There's your car driver policy. There's an umbrella policy that covers liability over $250,000. Those are 3 separate policies, usually issued by 3 separate carriers. Does everyone know what they're doing? Usually not. That vacation home up north may be a 3rd policy. That big boat you have may be a 4th policy. You may need a separate umbrella for that. So Mary Poppins never had so much fun as we have. All right, just to show you what else I have, I've got an umbrella insurance coverage letter. Fill it out. Fill this out on page 34, send it to your insurance agency, and sometimes they'll say, oh, that's the Gassman letter. Darn it. Okay, we'll check all this stuff for you. Oh, we found a gap. Sorry. In fact, I just reviewed my insurance, and I found that for the 2nd year in a row, unbeknownst to us, we have my car covered twice, once personally, once corporately. So the good news is I'm saving $967 this year. The bad news is I can't unsave it from last year, so you just have to be careful with the insurances. Again, every 2 to 4 years you should revisit your plan. I've got an article here on creditor protection for physicians, the most common mistakes, if you ever want to take a look at that. Number 41, is your spouse protected in the trust system we've talked about? Are your children protected? Are you going to have an outright disposition to your children, or are you going to allow them to be protected for their lifetime, which is what we prefer? Are you going to have a good trustee appointed for your children? Have you done your estate tax planning? That estate tax exemption may come back to $1 million January 1, 2013. It would not shock me if that happened. So, going back to the checklist, page 50, I know I've run over my time. I appreciate you listening to this. Please feel free to print this checklist out, and maybe someday we'll have an even longer checklist. Hit the most important 4 or 5 things, then hit the following quarter, hit the next most important 4 or 5 things. Take good care of yourself, and probably most important, have a fantastic day. I really appreciate your attendance and all your ideas, and
The broadcast is now starting. All attendees are in listen-only mode.
Good morning, Mr. Gassman. This is your 9 a.m. wake-up call. You have a webinar to do.
Holy smokes! Is it this morning we're doing the webinar? Wow! Look at all these people here. All right. Well, let's do it. Good morning. It is Saturday, August 6th. It's a beautiful morning, and I'm very honored to have so many physicians, clients, and CPAs on the line today listening to this. Now,